So how does someone like Warren Buffett actually decide if a stock is a good buy? Well, it's not magic. It's actually a system, a repeatable method. And today, we're going to put that system to the test with one company, United Airlines. We're going to use a simple checklist to see if UAL stock really has what it takes.
To kick things off, you really have to get this one core idea. I mean, Buffett's entire philosophy really just boils down to this single quote. He's not just interested in the stock price you see on the screen, he is obsessed with the real, underlying value of the business itself. The whole game is about buying a fantastic business for less than what it's truly worth.
And that's the billion-dollar question, isn't it? It can seem so incredibly complicated, with all the data and charts and noise out there. But what if we could just boil it all down to a simple process you can use again and again? Well, that's exactly what we're going to do right now.
Yeah, so to cut through all that noise, we're going to build a really simple but powerful checklist. Instead of drowning in spreadsheets, we're just going to ask 3 fundamental questions that get right to the heart of whether a company is a solid investment.
And here they are. Super simple. First up, does the company actually make good money? Second, is it buried under a mountain of debt that could sink it? And finally, the big one. After all that, is the price you're paying for a piece of this company actually fair? Let's run United through this, one step at a time.
Okay, first up, profitability. You know, a company can have the best story in the world, but if it's not generating real, hard cash from the money people have invested in it, it's a weak business, period. So how do we measure this?
For this, we're going to use a key metric called return on equity. You'll see it as ROE. Think of it like this. For every single dollar that shareholders have put into the company, how many cents of profit does it spit back out each year? It's just a fantastic way to measure how efficient a company is.
And for United Airlines, that number is 21.94%. Okay, but a number like that by itself is kind of useless, right? The real question is that good? Is it bad? Or just met?
So as a rule of thumb, anything over 15% is usually considered pretty strong. It shows that the people in charge are doing a great job turning investor money into actual profits. So at almost 22%, well, United Airlines passes our first test with flying colors. That's a big green check mark.
All right, one down. Let's move on to check number 2, financial strength. Because look, a company can be super profitable, but it could still be a risky bet if it's just drowning in debt, especially in an industry like airlines, where you're buying billion-dollar planes.
To figure this out, we're going to look at the debt-to-equity ratio. This one's pretty simple. It just compares how much money the company borrowed versus how much money the shareholders actually put in. If that number is really high, it can be a huge red flag, suggesting the company is leaning way too heavily on loans to get by.
And when we look at the data for UAL, their debt-to-equity ratio is 1.64. So for every dollar of equity, money from shareholders, the company has about $1.64 of debt. But again, is that a safe level to be at?
Well, it does change depending on the industry, but a good rule of thumb is that anything under 2.0 is generally seen as healthy and manageable. So at 1.64, United's debt seems to be under control. And boom, that's our second green check mark. So far, so good, right?
Okay, now for the final and honestly probably the most important test in the whole Buffett playbook. We know UAL is a profitable company, and it has manageable debt. But are we being asked to pay too much for it? Is the price actually fair?
A lot of people start with the PE ratio, price to earnings. It basically tells you how many dollars you have to pay for just $1 of the company's profit. Now, a low number can mean a stock is cheap, but you got to be careful because on its own, this number can be really misleading. We need to go deeper.
Okay, so looking at the numbers, UAL's current PE is 8.97. That's just a little bit higher than its 3-year average of 8.28. So it's not exactly on sale compared to its own history. But if we're really going to do this the Buffett way, we can't just look at today's price versus yesterday's price. No, we have to compare the price to what the business is actually worth. And to do that, we have to bring in the master concept, the holy grail of value investing, the margin of safety. It's pretty simple, actually. It's the gap between what a company is really worth, its intrinsic value, and the price you have to pay for it on the stock market. What you want as a value investor is to buy it at a huge discount. That's your margin of safety.
And this visualizes the whole problem perfectly. On one side, you've got the market price. That's what you pay. On the other, you've got the estimated fair value. That's what you get. And for United, whoa, the numbers are pretty stark. The market is asking for $91.71, but the data suggests its fair value is only around $69.23. That scale is definitely not balanced in our favor.
So this is the kicker, right here. Instead of getting that discount, that positive margin of safety we're looking for, we've got a negative one. The market price is almost 33% higher than the estimated fair value. From a pure value investing point of view, this is a massive red flag. You're not getting a bargain, you're paying a premium.
Okay, so we've run United through our 3-point checklist. It started off really strong, but that last test, well, it gave us a completely different result. Let's just put it all together and see the final score.
So here's the final breakdown. On the plus side, United is a really profitable company, great at using its capital, and its debt, totally manageable. But the big con, and it is a big one, is that the stock just looks way overpriced compared to what our data suggests it's actually worth. Look, the whole point of this isn't to say buy or sell United Airlines. It's to show you how powerful a simple framework can be. We took what looks like a mess of numbers and turned it into a clear story with a beginning, a middle, and an end. And that's a process you can use for almost any company out there.
And that really brings us to the most important thing to remember here. This checklist tells a really powerful story based on the numbers, but it's a story about what's already happened. It's all based on the past. It tells you nothing about, say, the quality of the CEO, or who their next big competitor is going to be, or what happens if jet fuel prices double next year. And this right here is where the art of investing has to meet the science. The numbers are great for telling you what a business is today, but the real multi-billion-dollar question is figuring out where it's going tomorrow.